Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Do your own research is one of the most parroted phrases in investing, slapped onto every stock tip, TikTok video, and crypto tweet. But what does good research actually look like for a retail investor?
And is what passes for research genuine due diligence or just confirmation bias? And in today's dumb question of the week, do contrarian investors actually make money? All right, let's get into it. So, do your own research. We hear it again and again in investing, and it's part good advice, but I think it's more often used as a disclaimer, isn't it? So perhaps the place to start is, what do retail investors often do mistakenly when they think they're doing research?
I think people often assume that content that they consume, things like TikTok videos or YouTube videos, are research, or should I say podcasts?
No.
But in fact, that's probably not the case, and it may be misleading. Because remember, the goal for these content producers is to get clicks. It's not to produce good research, which is going to increase your returns. Now, if you're always giving bad advice or bad content or bad information, clearly people will eventually turn away from you. But if you do want to do proper research, I'd say that this is not the way to do it. You're not going to find it just by opening up TikTok.
I think a lot of what investors think passes for research is actually a kind of confirmation bias, confirmation shopping, if you will. If you're a bullish investor, you tend to follow bullish influencers, seek bullish analysis, and any counter arguments or bearish arguments are often dismissed as FUD, fear, uncertainty, and doubt, aren't they? Have you seen that?
Yeah, I see people do that, and I see AI do it as well. Once it comes up with a certain way of thinking, it's very reluctant to switch, maybe because it mimics the way we think. But it is uncomfortable to have your cherished beliefs refuted by what you're reading, and I can see why people avoid that, even though it's probably in their best interest to do that. Another way of approaching this is to actively challenge your own beliefs when it comes to doing the research. So if you do find contrarian thinking, you should value that rather than get rid of it.
My feeling is a lot of retail investors look for shortcuts when it comes to doing research, because who wants to do research, right? You've got to read a load of boring financial documents, listen to earnings calls which are dry. Who wants to listen to a CFO talk about amortization? Nobody, right? And perhaps that leads people down the path of guru following and authority borrowing, is what some people call it, where you look for people who you think know what they're doing and you say, well, I'll just copy what they're doing.
But in a lot of cases, that doesn't make sense. For example, if it's a large fund, their goals will be very different to yours, and the types of investments which they can buy will also be different from yours. But remember, the goal for an active fund manager is to outperform, but only a little bit, and not to take too much risk and deviate from their benchmark too much. So if they have outperformed, you often see what they do is then go back to hugging the benchmark. And for them, it's a matter of career risk. If they do underperform for an extended period of time, they'll lose their job. And their choice of what they can invest in, if it's a large fund, is very restricted. For example, we saw lots of people trying to copy what Warren Buffett was doing, but in fact, he had such a huge fund that he simply couldn't buy a lot of those mid caps or small caps, which we would be able to buy and which would probably outperform over the longer term.
And it's not just Buffett, is it? You see people looking at all kinds of famous investors and trying to mimic their portfolios. Because they are published, there's 13 F filings in the US, which means you can see what they're holding, sort of. But the big drawback is it comes with a delay. So they're published more than a month after the quarter's end. So you're only seeing a snapshot of what they had many weeks ago. And there are limitations as well. You can't always see their derivative positions and shorts or even their reasoning, right? They might be holding things for a certain reason to balance something else in their portfolio. So I think blindly copying what some rich person is doing is certainly not research and probably not the way to run your portfolio.
And it probably won't suit your circumstances. And that's always why I say don't copy what I do, because your circumstances will be completely different to mine, and your risk appetite, and also your psychology. What you end up with is a portfolio that's just not suited to you. Now, that does unfortunately mean that there are no shortcuts, and you actually have to do the hard graft in order to find something that does work for you. And if the solution is not to do research in the first place, well, there are portfolios for that too.
But I like the fact that Wall Street has tried to profit on people's desire for a shortcut and launched funds over the years that track like guru indices, right? They look at what famous investors are holding and buy them in ETF form for you. But you look at the results and those funds have obviously underperformed the broad benchmark.
Yeah, so no shortcuts, I don't think. And it's easy to get misled by following other people. Although I would say it's probably worth learning about their process. How do they actually go about finding the information in the first place? Because it's very difficult to curate good information. Because nowadays, the analysis side of it is much easier now that we've got mind enhancing tools like AI. So essentially, that's increased our cognitive capacity for taking large amounts of information and distilling it. What it hasn't done, I think, is increase the quality of the information itself.
Even the analysis, though, that comes out of these AI tools, I do fear that it reinforces our confirmation bias. I've noticed that when I use Claude or Gemini or whatever, its opinion is often very coloured by how I phrase the question. Like I could phrase it from the point of view of a bull or a bear, and it might argue back to me from that point of view.
Yeah, it's funny because Laura heard me talking to ChatGPT about, just random stuff. And she said, you always tell her the answer before you ask the question. So she's obviously just going to repeat back what you said. And I think you're right. I think that's what we do.
But let's go back to the good old days before AI. What would a professional fund manager be doing when they're looking at stocks? What does their day look like? And how much of that can we mirror as retail investors?
If it is a single stock analyst, then a lot of the time would be spent reading the company reports. That's the original source information after all. Remember that an analyst at an investment bank can actually call the CFO. If they're worried about some of the numbers on the balance sheet, they could just say, "Hi, I'm just looking at this. What's wrong with it?" And they can actually arrange calls with the management themselves. So there is that kind of access aspect to it. But does that help?
Yeah, that's what I was going to say. I was listening to a podcast with some hedge fund managers, and they said, never talk to the CEO of a company. You can. If you ring them up, they'll talk to you. But they're such good salespeople. That's how they've got to be CEO of a big company, that you're going to get sweet-talked into buying the stock.
Yeah, I think that's a danger. And it's very difficult to be objective when you're kind of friends with the management of that company. That's always going to cloud your judgment. And it's very difficult to be objective once you've kind of got that friendship in place. But look, that's part of the information they'll get. They'll also look at pre-digested information from investment banks, because usually a large cap stock will have multiple analysts covering it at Goldman Sachs, UBS, various investment banks. So they'll be flooded with research from those sources. And of course, now on the Bloomberg terminal, there's AI built into the system, and they can look at those digested reports and see kind of summaries of that information. Often they'd also have in-house research teams who'd be feeding them ideas. So there'd be economists who'd give them top-down information. So if you're covering the auto sector, for example, there may be things like tariffs, there may be things like economic growth, which is going to affect sales. Inflation would affect it, interest rates would affect it. So all of this will feed into the decision process. But I think what really marks out good from bad analysts is sifting through all of that information to work out what's important. Because the great analysts are the ones which can see through the noise and just pick out those critical facts.
So thinking about everything you've just said, some of that we can mirror as retail investors if we want to. We can look at the company filings, they're public. We can see what insiders are buying and selling. We can read some of the sell-side analyst reports, but not most of them. We certainly don't have access to a Bloomberg terminal or FactSet or any of these other professional tools. We can't call up management. And maybe more importantly, we don't have the resources to go and speak to the customers and the suppliers and the competitors of a company and build that full picture and try and get ahead of what might be coming in earnings by seeing if their customers are pulling back.
And it even goes beyond that. Nowadays, investment banks and hedge funds are trying to go to the next level of information. For example, monitoring video cameras outside shops in order to see what the footfall actually is. Lots of people going to the shop, and what times are they going in? What are they buying? And that kind of granular detail can really help them when it comes to forecasting revenue, profit.
Did you see that one of the hedge funds, Citrini Research, sent someone to just sit on the banks of the Strait of Hormuz in recent weeks and watch the traffic because they didn't trust the satellite imagery or anything? So we'll just send someone to sit there. And then he got picked up by one of the spy agencies, I believe.
You'd need good money to do that, I suspect.
But we're not sending anyone to the Strait of Hormuz, are we?
Not that I'm aware of. But that's a whole different level of paranoia, isn't it? If you don't trust satellite images, as if they'd be edited. But look, all of this is things that we wouldn't have access to as retail investors. So we don't have any kind of edge from that point of view. Now, that's not to say that we don't have any edge at all. I think we do, in terms of the type of stocks we can buy. Our investment horizon makes a massive difference to the choices we make. And our risk appetite, we could have a huge risk appetite if we don't really care. If you've got enough money and it's your fund portfolio, well, do whatever you want and take lots of risk and learn your lessons.
We can certainly take more risky concentrated bets than professional fund managers typically do. And as a retail investor, you could concentrate your portfolio if you wanted in 5 positions, and then they will meaningfully affect your performance. Whereas if a fund is split between 100 stocks, you're basically buying some form of beta.
Yeah, you're just buying market exposure with a slight tilt. And that's probably what your risk department will ask you to do. Plus, many of these funds are constrained by the actual description of the fund. Their remit is very much constrained.
And of course, the elephant in the room behind all of this, despite all of those resources that we've just talked about, active stock pickers, professional ones, tend not to outperform. The vast majority don't. So as a retail investor, you can say, well, am I even missing out on anything anyway?
And that's often the conclusion people come to. I can't really create any kind of edge. There isn't an informational edge. If anything, you're starting off at a huge disadvantage because you've only got the publicly available information. When it comes to the analytical side of it, well, we've got AI tools now, but as you say, I think that might be creating your own machine-generated echo chamber. That's not to say you shouldn't try, because I think the whole process of buying single stocks is just great fun. I love it because you do learn about things and it kind of takes you out of yourself and you can learn about what your limitations are. That's usually my conclusion. But it is interesting reading about what companies are doing, the reasons for their success and failure. That's just fascinating stuff.
Yeah, Warren Buffett said, if you want to get smarter, read 500 annual reports. That's how knowledge builds up. It's like compound interest.
That's a great point. And this is a great way to learn, I think. And I don't know if this is helpful for people, but when I used to study physics, if there was a particular topic, I used to read around it and learn more than I needed to answer a specific question, because then I found that somehow that kind of taught me better if I knew more around the subject, sometimes even slightly tangential subjects. And that way, by over-preparing and casting your net wide, you understand better when you focus in on a specific thing.
I think I'm the same as you. I do find it fascinating, even though I know I can't beat the market, or I'm very unlikely to. So I think the lesson is, if you're interested in this stuff and how the real world is reflected through companies and their finances, set yourself that fund portfolio and play in that sandpit, but don't let it contaminate your core. We say it so many times, but it's worth reiterating. But I do want to come on to what does good research look like? We've spent quite a bit of time saying what it isn't. We should come on to what it is. Now, I think the first point to make is, where in that information chain are you actually focusing your attention? Because the primary source material might be the annual report of the company, which the CEO and the CFO are putting their names to and are guaranteeing legally that this is a factual representation of what is going on inside the firm. So if you read through that, you should know quite a lot about what's going on. But people typically don't read that, do they? So there's one step removed from the company reports, which is the analyst report, where they digest it, they put a bit of spin on it, they contextualize it in the industry, all of that stuff. People don't tend to read them either. The next step from the analyst report might be the broker summary, where they pull together all the different analyst reports and their stock forecasts, and they bundle it all together and say, is this a buy, sell, or hold? People do look at that. But what people probably pay more attention to is the financial media, where they summarize the broker summaries. And I think increasingly these days, people don't often look directly at Bloomberg or the FT even. They might just get it through social media and YouTube, which is based on the Financial Times story. And so eventually, if you're sort of the typical retail investor, what started out as that annual report has been fed through all these layers, with nuance maybe being diluted at each stage. And I wouldn't trust the information you get at the end of it. Sad as that is to say as a podcaster.
I agree with that. I think that's true. I think most people consume information that way. But it's what happens next, I think, which is really critical, which is, let's say that a particular sector's been highlighted as being interesting, and then you look at single stocks within that sector. Well, then you can go back to the source and work out from the company reports what your assessment is of the individual companies. And I speak to people who do this. You know, they have power hours with me where we talk about single stocks and they talk about their analysis. And often it's amazing what they've managed to work out for themselves. And they do this to educate themselves. They don't think they can beat the market. At least I try and convince them they can't. But we do it because it's fun. And they like learning about the mechanics of the companies, what they do, what their results are, and then working out what kind of trade you can put on based on what the report says.
So it's one thing gathering all the information from the primary sources and reading around the subject and forming a view on that company's prospects. But how do you actually make that a rigorous process? Now, if you had any kind of professional training in finance and investing, you'll have had to sit through many modules, I assume, on financial modeling and doing discounted cash flow models, DCFs, to formalize that process and say, this is the balance sheet today. These are my assumptions about revenue growth and profit margins and the total addressable market and the cash flows the company will generate way out into the future. And working back from all that, this is what I think the stock should be priced at today. Oh, is that above or below where the actual stock price is? That's the kind of process you go through. But I don't know how many investors actually do that process or how useful it is.
Yeah, I mean, I used to teach courses about this at investment banks to the analysts themselves when they were first hired. And, you know, you have to teach it and you have to be able to create the models if you work at an investment bank. Will they actually use it in practice? And if they publish one of these models outputs, do any of the analysts read those reports and care about what they've written? Possibly not, unless it flags something absolutely egregiously weird.
I know that Aswath Damodaran, who is one of the most prominent modelers, if you like, he's the Dean of Valuation at NYU, and he does DCFs all the time. But he argues that it's the process of modeling that is way more valuable than the actual number it produces at the end.
I think that's absolutely true, because what it does is standardize the inputs to the model, and it makes you think about what the company is. So when he publishes his Tesla valuation model, that's really a story about what is this company? Is it a software company? Is it a car manufacturer? If so, this is what the margins would be based on those two assumptions. And it makes a massive difference according to what kind of company you think it is. Is it a robotics company? You know? And that's why people looking at the same data can come up with completely different valuations based on what goes into one of these discounted cash flow models.
And that's why I'm a little skeptical of them, because you can tweak the knobs, the inputs, very slightly, and it makes a massive difference to what is spat out as a fair valuation for the company. But I do think it's useful because it does force you to make assumptions about growth and margins and risk explicit. Like, you actually have to write them down. This is what I think the company will do over the next year, 2 years, whatever. But there is a version of the DCF which some people argue is more useful than just starting with that blank spreadsheet and filling in your assumptions. And that is the so-called reverse discount cash flow model, where instead of projecting cash flows forward into the future, you start with the current stock price and try to work out what that is implying about sales growth and margins and costs and all of that stuff.
Yeah, as a strategist, we worked it both ways. That was a great way of generating reports, which was to say, look, if we back out what's assumed, what does it tell us? You could do it at the index level as well. And that was always interesting too. But I think that's what modeling adds. I think you're right. I think that's the real value. It makes you standardize the way you approach the analysis. It makes you put numbers on the table, which you can then question. But you have to know things like margins, what the discount rate is, what the cost of capital is for that company, and how it affects valuations. Does that mean it's right? No. But is the process worthwhile? Yes.
I think you have to accept that it's imprecise, right? There's this massive danger of false precision. I remember Charlie Munger, who obviously worked with Warren Buffett for a long time. He once said, Warren, you're always talking about these discounted cash flow models and how that forms the core of our investment process, but I've never actually seen you do one. And Buffett said something like, yeah, because if you have to do one, it's too close. Like the decision should be obvious without doing it, just by looking at core metrics like free cash flow yield or something like that.
And again, that's a benefit of doing the granular stuff, because then you can step back and build your intuition based on what you've done. But you can't get to the Buffett level without going through the DCF grind in order to get there. Another way of approaching this is to look at fundamental valuations and compare companies based on those valuations, but also multiple metrics. Don't look at just one metric, look at multiple metrics, and always compare different stocks within the same sector, across sectors, based on those scores. One of the things I've been using a lot is Stockopedia for the single stock portfolios I've got. And it is valuable in the sense that it allows you to screen huge amounts of information and come up with numbers which presumably capture some element of truth. So I wouldn't be too nihilist about this. I think you can actually look at those public numbers and make sense of them and also use them in the investment process. Just don't put too much faith in it, is what I'd say. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so we talked a lot about the numbers, which you can't avoid, can you, when you're analysing things like stocks? But in investing, psychology is just as important, possibly more important. So let's talk about that for a while. Before you buy a stock, what kind of process do you need to go through to ensure you're buying it for the right reasons?
Well, I can only speak from personal experience and my fairly checkered history of single stock purchases. But look, what I do is I really focus on process. What I've discovered is if I buy things on a whim or because it's kind of trendy at a particular point in time, it always leads to disaster. So I have to have an absolutely meticulous process, which I follow mechanically. Otherwise, it just doesn't work. So for me, that's how I keep my psychology out of the overall equation. I know lots of other people do it that way. For example, when I talk to Jim O'Shaughnessy, that's his approach as well. That's why he did his huge book about backtesting strategies and looking at what works on Wall Street. Now, that's not to say that works for everyone. Some people prefer narrative. They prefer to read written reports than look at numbers. So maybe that just reflects my own bias, but that's certainly what's worked for me in the past.
I think one of the keys as an investor is to try and overcome overconfidence and that idea of the confirmation bias we've already talked about. And you need some way to introduce opposing opinions and opposing facts into your analysis. Now, one thing I've seen talked about a lot by various psychologists is the idea of a pre-mortem, which is before you take an action and make a decision, imagine that investment has already failed in the future and then work backwards to explain why. And I know that Daniel Kahneman, for instance, said that this is one of his favorite approaches for making decisions.
Yeah, the reason why I like this, and I hadn't come across it before, the reason why I like it is that it forces you to question your beliefs. So that comes back to this idea of creating a realistic map of reality rather than just living in an echo chamber. And this forces you to question what your assumptions are before you buy. There's a nice quote from Kahneman where he said, "My expectation is that a pre-mortem will not change your mind about the plan, but what it can do is help you find loopholes that you can close."
Yeah, I think it's helpful for flagging up areas for further research. Like if you do a pre-mortem and you're thinking, oh, this company probably failed in the future because the star CEO retires, then maybe you're going to drill into the succession plans in a lot more depth right now. And if we were to flip it round, what you're really trying to get at is what would have to be true for this investment to work? And that question actually comes up again and again in management theory and psychology. And many people find it a more helpful framing than what is true, especially if you're working in a team, because you can probably all agree on what would have to be true for this to work. And then you're going to get some falsifiable assumptions.
Now, this is based on some ideas from Karl Popper, who was very famous for the philosophy of science. And his point always, his underlying big idea, was that ideas have to be falsifiable. If a theory isn't falsifiable, then it's not useful. And it turns out that George Soros actually studied under Popper at the LSE and actually came out with this quote that I'm only rich because I know when I'm wrong. In other words, he was willing to falsify his hypotheses. But I think the reason why this is valuable is, okay, we can come up with a list of reasons why an investment's good, but it's also useful to have a list of reasons why that might be refuted in future. For example, you quoted the change in management, or it could be a fall in sales. But it's important to have that framework in mind when it comes to building the investment thesis in the first place.
I think it's especially valuable when you're looking at a growth stock where you're relying on a boom in sales and a growth in customers in the future. Asking what would have to be true for that to happen is really important when there's a lot of different prospective futures. So to use an example from the current day, SpaceX is probably going to list for the first time on public markets later this year. And if you believe all the rumors, it's going to list at an astronomical valuation, maybe putting a price of as much as $2 trillion on the company, which is, a crazy multiple of sales and earnings, at least as it stands today. So maybe asking yourself, what would have to be true for SpaceX to genuinely be worth that much money? You're probably better placed to answer that than me, Robin, but I'm guessing there's assumptions around the viability of space travel, how many competitors are going to emerge, how much money is the government going to throw at this kind of thing? Are we going to find alien customers? There's all such things. Like, what has to be true?
That would increase the total addressable market, wouldn't it? Now, that was a growth stock. If you're buying a value stock, well, clearly the decision there is based on it actually being cheap. And eventually, if you're right, it'll stop being cheap. So having an idea of what that valuation should be would also be important. So whatever the style of investing, whether it's quality, value, momentum, there are kind of pre-built filters which essentially tell you when to sell. But just bear those in mind before you buy.
Absolutely right. We focused on reasons to buy, but you need to know what you're buying for and probably write down up front what would cause you to sell.
Yeah, because both those decisions are effectively what drives your profit: buying price, selling price, and hopefully number go up.
Yeah, would you say buy low, sell high, Roman? Is that the way to think about this?
I always get that the wrong way around. I think that's the problem.
A lot of investors will talk about the idea of going in with a checklist, formalizing the process and running through different criteria and ensuring that what you're doing meets those criteria every time you buy or sell a stock. But the difficult thing is pretty much every investor has a completely different checklist.
Yeah, there is no standardized checklist. And this is something you've just got to learn by trial and error. I mean, pilots have learnt this over decades of flying. My dad had a pilot's license and he used to run through the checklist before we took off in this little Cessna. And I always found that fascinating. You know, there is a standard way of checking things, and he'd kind of press on the pedals and you could watch the flaps move. And I'd check, Roman, are the flaps moving? Of course, he'd check himself. He wouldn't ask a 10-year-old. But I just love the process. I thought that was great, especially for Dad, who was basically a nutter. So, for him to do that checklist told me a lot.
Yeah. And I guess the point is, it doesn't matter how good a pilot you are. Even if you're the best pilot in the world, you still need to run through your checklist.
Yeah, part of his checklist was a little shot of vodka before we took off. And I think that probably wasn't on the standardized checklist.
That's what I said. Everyone's got a different checklist. But other than vodka, what would be on the very basics of a stock investor's checklist?
I think understanding the company is very important. What is it that the company does to make money? And how effective are they at doing that? And are they more effective than their competitors? That sounds like a really basic question. But for many businesses, I just look at it and say, I don't really understand what you do after reading your website's description. And that's a red flag for me.
I guess this plays into Buffett's idea of the circle of competence, right? You should only really be buying a stock if you can genuinely explain in a couple of sentences to a layman what it is that the company does, how it makes its money, what's its competitive advantage, its moat, if you like, and is it durable?
Plus, I think some kind of checklist on the balance sheet is never a bad idea, and also the cash flow. So has it got a lot of debt, which is going to be difficult to service, which might run the company to the brink of bankruptcy or beyond? What's its revenue growth like, and is it sustainable? What's the price relative to free cash flow, relative to book value, relative to profits? And what are the margins like?
Yeah, it's hard to come up with any kind of standardized financial checklists for an investor because it depends so much on what kind of investor you are. The metrics you're looking at as a value investor are going to be so different to a growth investor, but you need to have, I'm guessing, some kind of financial checklist and valuation checklist.
And depending on the kind of investment you're buying, are you buying a turnaround company? In which case, yeah, the valuation's going to be pretty low. But the real question there is it going to recover? Or if you buy growth stocks, is the thesis for that future growth still in place? So the checklist will vary depending on what it is you're buying.
And the other area I think needs a bit of drilling into is management, because they're so important to whether a company can actually execute on its plan. It might have the best strategy in the world, but if the management's crap, you're unlikely to make money on the stock.
Now, if you do speak to people who read these company reports day in and day out, there are always things which they immediately zoom in on. And you can see them, you hand them the report and they'll just quickly flip through it and they'll point to something and they say, oh, that's a problem. So how on earth can they do that? Well, you learn certain red flags. One, for example, might be cash flow diverging from reported earnings. That's a fairly standard thing that people look for as a sign that the accounts don't look quite right.
That there's a certain amount of book cooking going on, potentially. It doesn't mean there is, but it's worth drilling into, isn't it? Because earnings can be manipulated to some degree, depending on what the finance team is doing around depreciation and amortization and recognizing revenues in different quarters. Whereas cash is much harder to manipulate unless you just literally are lying about the numbers completely.
Which you can't rule out.
Which has happened, let's be honest. That has happened. Wirecard had like 2 billion euros of cash that wasn't even there. But certainly, if the cash flow has diverged massively from the reported earnings, it requires an explanation, doesn't it?
Oh, definitely. And there are various scores you can look at, like an M score or a Z score, which tells you about bankruptcy prediction.
Yeah, I think the M score, which has been around for a long time, looks at 8 different variables from the financial accounts and gives you an indication of how likely it is the company might be manipulating its earnings to some degree. And historically, it comes up with some false positives, but it's fairly reliable at flagging up companies where all is potentially not as it seems.
And the Altman Z score works out the probability a company could go into bankruptcy. And historically, it's been fairly accurate, but it's not waterproof by any means.
But these things are often used as quick ways of flagging up areas of concern and things that need to be drilled into.
When you're researching the company, it's probably worthwhile looking at news stories which talk about changes in the auditor. Because if the auditor steps back, then you're thinking, why did they do that? Is it because they had too much business? Or is it because there was an issue which they didn't want to report?
Yeah, the auditor leaving and not being willing to put their name to the current accounts is sometimes a red flag. CFO leaving as well is another one. People are like, things might not be quite as they seem.
Or if the corporate structure is really complex. I remember some of the water companies were just Byzantine. Yeah, I couldn't even start to understand how something like Thames Water was structured, for example. If that's the case, then it really puts me off trying to understand the investment, and I probably wouldn't even invest as a result.
There's so many companies I look at which are in financial services, maybe they're insurers or something like that. And usually they're split across territories, sometimes with a headquarters or a tax base in Bermuda. And they always say stuff like, well, it's not for tax reasons we've gone there. And I'm like, really? Is
Yes,
it
the
because
weather.
of the sunshine, is it? Yeah. I don't think those kind of things immediately exclude a company, but they mean you need to drill into it and be skeptical about the things written in their official reports.
So we've talked about various ways of analyzing these companies and certain things to watch out for. But if you do have a checklist and it's getting really, really long, well, maybe there's over-analysis here, which may not help you.
I think that's definitely true. We started this whole thing off by talking about how to do your own research. Well, there's a lot of research which shows that too much information is not helpful when you're making a decision like this. In fact, it might not make the decision more accurate, but you will become more confident and overconfident in the decision you're making.
So maybe the way to imagine it is that as you get more and more information about a company, you're digging a groove into the ground, which kind of channels your thoughts. But if you dig it too deep, then the ability to change your thought process becomes much more difficult. So don't go too deep. Just carve out a rough channel and allow for the possibility of changing your mind down the road.
And maybe that leads us on to an interesting question, which is how should you act based on the research you've done? Different investors have very different views on this. Some would say, you need to understand everything and be very confident before you take any position. Whereas other very successful investors, like Stanley Druckenmiller, take the opposite approach. His philosophy is buy first, analyze later, which sounds weird, doesn't it? But he says take a small position in something you believe in on first principles. So you've got skin in the game, then do a lot of research and either double down or pull out. But he says move and then do your research. I don't know. How do you feel about that?
I think that's interesting because I think it's true. If you've got skin in the game and you make a loss, well, you'll pay a lot more attention than if it's just a theoretical exercise. That's not the way I approach it. As I say, for me, it's a very mechanical process and there are very clear rules as to what happens. And I'm just there to push the buttons, really. I'm just like a performing monkey in front of the data.
Perhaps he's looking at different investments because he thinks markets move fast. And maybe he's talking about very tactical trades where you might not have time to do that very broad research that professional investors might do, where you talk to the customers and the competitors and you send people to the Strait of Hormuz. Maybe you don't have time to do that.
Yeah, I think that's a good point as well, which is how much time can you dedicate to the actual analysis yourself? Whatever process you end up with has to fit within your lifestyle. If you're a busy parent, then you're not going to have a lot of time to do all of this stuff.
And I think you need to be honest with yourself about why you're doing it. If you think it's because you're going to get rich quick and beat the markets, like probably not, right? Probably not. Even the pros can't do that for the most part. And they have far better information than we do. If you're doing it for learning, cool. But if you're secretly hoping to get rich, but then saying you're doing it for learning, that's also a problem, right? You've got to be honest with yourself.
I think another way of approaching this is to ask peers who you respect what they think. And that's one of the things our community offers. If you wanted to discuss an investment with other people who are fairly well informed but also helpful, then you can do that as part of our community. To learn more about joining, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Do contrarian investors actually make money?
So let's imagine a strategy where you short markets if they're expensive. Well, if you look back over the recent years, you'd see that it's been expensive for a long time. So clearly that strategy would have been catastrophic. So I think it depends on how you approach this contrarianism.
Yeah, it probably sounds trite, but do contrarians make money? Some do, some don't, right? Certainly a naive contrarianism, where you just blindly do the opposite of what the consensus is, will not make money because the crowd is right most of the time in investing. Markets trend, and they tend to trend upwards. And the successful companies get more successful. So if that doesn't really work, what does work? Well, you could say contrarian investing is kind of value investing, really.
Yeah, because the popular companies are the ones which have their prices bid up. And if you go for value, by definition, it's a contrarian approach. Income investing, which is another flavor of value, is in a sense contrarian because of its value tilt. But if you are going against the herd, it's incredibly painful. And there can be long periods when you're really underperforming by a significant margin. Value investors famously over the last 2 decades, up to about 2026, were very much out in the cold. They were massively underperforming.
But the very long-term evidence still shows that buying value stocks outperforms the broad market.
Yeah, the evidence is very strong that that's the case. But what that doesn't tell you about is the psychology of it and the pain of it when it goes wrong, or at least it seems to go wrong. I think it takes a huge amount of self-belief in order to stick with a position if it hasn't outperformed for a long period of time. If everyone else is making lots of money and telling you about it, and you're languishing with an underperforming portfolio.
Yeah, you kind of have to buy stocks which are doing badly or disappointing, and everyone's telling you you're an idiot. Why didn't you buy Nvidia? And you have to be like, no, I believe these little unloved companies have something going for them and they're going to come back to a fair valuation.
That's why I think something like value combined with momentum is probably better, because at least then you don't have to wait as long in theory, because these are companies which are cheap now, but which are kind of turning the corner, either in price action or in terms of earnings improvements.
So Howard Marks has a 2x2 framework, which it might be worth thinking about here. So if you imagine a grid with 4 boxes, you can either be in the consensus or you can be non-consensus, i.e. contrarian. And you can either be right or you can be wrong. So you've got 4 different options. If you're consensus and right, you'll basically deliver the average return of the stock market over the long term, which is fine. If you're consensus and wrong, you'll do what a lot of fund managers do, right? Active fund managers, and you'll underperform, but not dramatically.
You'll fail conventionally.
Yeah. If you're non-consensus and wrong, things are going to be disastrous, right? Because you're betting against the herd and you're picking the wrong things.
And if you're a fund manager, you'll lose your job.
Yeah. But the last box, which we're about to mention, is the only box where you might make really serious money from outperformance. And that is if you're non-consensus and right. You're the great contrarian investor. That's what Howard Marks says the serious money is made.
I think that's a great analysis. I'd never heard that before. I absolutely love that. And people make their career from being in that box just once.
Yeah, you only have to do it once, right? As long as you don't lose money the rest of the time. If you have a big trade that goes in your favor when everyone else is betting the other way, you're going to be rich and you're going to be famous and you're going to be on many, many podcasts.
So if you've listened to this and you think, yeah, I've got a pretty good framework now, which I can apply to buy my own single stocks and pretty much work out what to buy, all I'd say is you don't have to do that. And if you are going to do it, size the trades appropriately. Keep it in the fund portfolio because that's what it is.
I think that's the most important thing in this whole episode, is that for the vast majority of people, this is not the way to build wealth. We've done many an episode on why index funds work and free you from the problem of trying to find needles in the haystack, and just riding that upward drift over many decades is probably going to get you where you need to be. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.